Welcome back to Iraqi Dinar, your trusted source for in-depth insights on foreign currency markets, global economic trends, and exchange rate movements. I'm Ali, and today we're exploring something a little different. While we usually focus on the Iraqi dinar, we're turning our attention to another currency that's quietly gaining traction in international finance, the Vietnamese dong. Now, the dong may not be as widely recognized as the US dollar or the euro, but it's steadily earning its place as a currency to watch in Southeast Asia. Vietnam's economic transformation over the past few decades has brought the dong along with it, and what was once seen as a fragile and overlooked currency is now becoming a reflection of Vietnam's rapid modernization and financial credibility. To really understand the dong's current standing, we need to look at how far Vietnam has come. After years of war and economic hardship, Vietnam began a new chapter in the late 1980s by introducing a series of sweeping reforms known as Doi Moi. This was a pivotal shift from a centrally planned economy to one that embraces market dynamics, international trade, and private enterprise. These changes opened the door to foreign investment, entrepreneurial innovation, and a stronger integration into the global economy. Alongside this economic evolution, the dong began to find its footing. Yes, it has historically had very high denominations. Notes worth hundreds of thousands are still common, but that doesn't mean the currency is weak. High denominations are often a legacy of past inflation. What matters more is the broader economic context in which the currency operates, and today, the dong is increasingly supported by solid fundamentals such as rising exports, strong foreign direct investment, and improved macroeconomic discipline. Vietnam's central bank plays a critical role in ensuring this progress doesn't come undone. The country uses a managed float system, meaning the State Bank of Vietnam sets a daily reference rate for the dong and allows it to move within a certain band. If the exchange rate strays too far from the target range, the central bank can intervene, either by buying or selling foreign currency or by adjusting monetary policy. This approach helps strike a balance. Too much fluctuation can hurt exporters and scare away investors, but too much control can stifle market confidence. So far, Vietnam has managed to walk this line effectively. One of the biggest forces supporting the dong is Vietnam's position as a global manufacturing powerhouse. The country exports a wide range of products: electronics, garments, footwear, agricultural goods, all of which bring in foreign currency. These exports strengthen Vietnam's trade balance and create consistent demand for the dong. At the same time, Vietnam imports large volumes of materials it needs to power its factories: fuel, industrial machinery, components, which requires foreign currency to pay for. This creates a constant tug-of-war in currency demand, balancing what the country sells to the world with what it needs to buy. It's this interplay between exports and imports that adds to the complexity of managing the dong. Beyond trade, foreign direct investment has been a game-changer for Vietnam. Over the past 2 decades, major global corporations have poured billions into the country, attracted by low production costs, political stability, and a favorable geographic position in Asia. Companies like Samsung, Intel, and Foxconn have set up large-scale operations, and their investments generate real, tangible demand for the local currency. Whether it's paying wages, buying supplies, or expanding facilities, this flow of money into the Vietnamese economy reinforces the strength and stability of the dong. It also reflects increasing international confidence in Vietnam's long-term potential. Inflation, however, remains a challenge for any emerging economy. It can erode purchasing power and weaken the credibility of a currency if left unchecked. Vietnam has had its share of inflationary periods, often driven by rapid growth or rising global commodity prices. But in recent years, the central bank has adopted a more sophisticated and data-driven approach to monetary policy. By using tools like interest rates, money supply regulation, and open market operations, the State Bank of Vietnam has been able to keep inflation relatively stable. This kind of stability is essential for building trust in the dong, both domestically and internationally. Interest rates themselves are another important factor in determining the dong's strength. When Vietnam raises its interest rates, it can attract foreign investors looking for higher returns, which brings in foreign capital and helps strengthen the dong. But it's a balancing act. Raise rates too high and you risk slowing down economic growth. Keep them too low and you may trigger inflation or see capital flight. So the central bank not only has to monitor domestic conditions, it also has to watch what's happening globally. For instance, when the U.S. Federal Reserve hikes its rates, capital often flows back into U.S. markets, putting pressure on emerging market currencies like the dong. Vietnam's ability to navigate these global shifts is a testament to the growing maturity of its financial system. Another crucial but often overlooked element in currency strength is Vietnam's participation in global trade agreements. The country is a signatory to several major trade deals, including the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, and the EU-Vietnam Free Trade Agreement, EVFTA. These agreements have opened the door to larger markets, reduced trade barriers, and attracted more foreign investment. They also push Vietnam to raise its standards, introducing stricter regulations, improving labor conditions, and enhancing corporate transparency. These reforms, while challenging, help modernize the economy and support the long-term value and credibility. Looking ahead, Vietnam has signaled its intention to gradually shift toward a more flexible exchange rate regime. This would allow the dong to respond more freely to market forces rather than being tightly managed by the central bank. It's a bold move and not without risk, especially in a world of global financial uncertainty. But if executed carefully, it could help the dong become more resilient to external shocks such as oil price volatility, trade disputes, or geopolitical tensions. For this transition to succeed, Vietnam will need strong institutions, a deep financial system, and public awareness of how flexible exchange rates function. Still, it's a step in the right direction, one that aligns with Vietnam's broader vision of integrating further into the global economy. For anyone considering investments linked to the Vietnamese dong or simply trying to understand where it's headed, the key is to monitor macroeconomic indicators. These include GDP growth, inflation rates, interest rates, foreign exchange reserves, and trade balances. These are not just technical data points, they're foundational to currency strength. When the economy grows consistently, inflation stays low, and investment flows remain strong, the dong tends to strengthen. But if any of these pillars weaken, the currency could face downward pressure. We also can't ignore the geopolitical landscape. Vietnam's rising role as a manufacturing alternative to China means it's increasingly impacted by U.S.-China trade tensions, global supply chain shifts, and regional stability issues. All of these elements feed into the complex equation that determines the value of the dong. So where does all this leave us? The Vietnamese dong isn't the go-to currency for short-term traders or speculators. It's still under central bank management and lacks the full flexibility of a floating currency. But it is steadily attracting interest from long-term investors, emerging market funds, and strategic thinkers who recognize where the world is headed. Vietnam is not just surviving, it's thriving. It's modernizing, welcoming investment, and growing into a more significant player in global finance. What was once seen as a weak and unstable currency is now becoming a symbol of economic strength, discipline, and ambition. The dong is evolving in real time, and its story mirrors Vietnam's broader rise on the world stage. Challenges remain, of course. No emerging market is without risk, but Vietnam's consistent policy reforms, stable inflation, and export-driven growth suggest that the dong is on a promising path. As we wrap up this deep dive, remember, the value of a currency isn't just about the numbers printed on the note, it's about trust, policy, stability, and the story a country tells the world about its future. And Vietnam, through the lens of the dong, is telling a story of progress, discipline, and upward momentum. Thank you for joining us on this edition of Iraqi Dinar Updates. If you found this discussion helpful, make sure to like, share, and subscribe. Your support helps us continue bringing you thoughtful analysis on global currencies and macroeconomic developments. More updates are on the way, including the latest on the Iraqi dinar, regional economic trends, and shifting movements in the global financial landscape. Until next time, stay informed, stay curious, and stay financially prepared. This is Ali, signing off.